and it's come in below expectations, all but rules out an interest rate rise next week.
Like you say, it's some good news. There hasn't always been good news in these releases. So
why would I increase interest rates now? All the anxiety has come from the month-on-month print.
they're not under immediate pressure to kind of stamp down.
But then the last couple of months have opened up a door. It might have a negative impact.
loop. It's like rates went up,
I need
alcohol
more.
consumption goes up.
Yeah. Australia, fantastic news. I'm sitting here at 12 o'clock, 30 minutes after the latest inflation data release. And it's come in below expectations, which all but rules out an interest rate rise next week. It even opens the door slightly ajar for a potential rate cut in 2024, which some major bank economists are predicting. It is really, really positive news because this economic print was so important and it was really dangerous. If it came in higher than expectations, the RBA would have had a lot of pressure to increase interest rates. Instead, it's come in pretty much in line, a little bit below, which should take off the pressure from the RBA to increase interest rates next month and continue this holding pattern. Curtis, how are you?
Yeah, much better than an hour ago. Like
Yes.
you say, it's some good news. There hasn't always been good news in these releases. So yeah, good to hear. And I think what you said is key. Like this data release is really, really important because the quarterly numbers are really what counts for inflation. They release the monthly numbers now, like the ABS do, which they came in a bit high, like the last couple of readings. But essentially, the last 3 months, like you can shred those numbers. They're now not relevant. The only relevant number is the inflation print that came today. That's what gets relied on. And luckily, that is a much more favorable number and print for inflation than it was tracking on like a month-to-month basis.
Yeah, I think that is really key. All the anxiety has come from the month-on-month prints.
Yeah.
The last 2 month-on-month prints are just like, oh, okay. Yikes, this quarterly print could be really bad. It could start with a 1, 1.1, 1.2. Uh-oh, that would just really force an RBA rate rise. That was the number that we had. I did a video on Friday on our YouTube channel that said the number of 1.1 would all but rule in a rate rise. It's coming at 0.8. And I'm talking about the trimmed mean inflation number. This is the RBA's preferred measure when they're working out what the inflation number is. There's quite a few different measurements. They look closely at the trimmed mean one because it excludes all the volatile stuff and they get a better picture of what is actually happening to inflation. That number came in at 0.8%, which, you know, is pretty encouraging and it's broadly in line with their year forecast. It's almost exactly online. So, you know, inflation is tracking where the RBA thought it would, and they haven't thought that they are going to increase interest rates. So that's kind of the narrative is, why would I increase interest rates now? Inflation is not necessarily going higher than we expect. It's pretty much moving back into band on the trajectory that we had it at as of today.
Yeah, exactly. So it's, you know, it's not in band now, but, you know, they're going, we want it in band by end of 2025. This keeps it on their forecasted trajectory to get there. You know, obviously they would like it coming down faster, but you know, they're balancing a few things as well. Like they don't want to tip their economy into a big recession, which some of the other economic indicators are pretty weak at the moment. So I think, like you say, it takes a bit of the pressure off in the balancing act that, you know, Michelle Bullock and the RBA have, where they're not under immediate pressure to kind of stamp down, you know, like those crocodiles that come up in the children games that you have to whack down with the paddle. Like there's not a 1.2 reading that they have to go bang and hit it immediately. They can kind of continue to sit tight, leave monetary policy where it's at, and essentially wait for more data, another quarter probably really to come in before they're making another decision.
Yeah, I would go so far. That's exactly right.
Yeah.
And most lead indicators for the quarter ahead is suggesting quite a low print because of all these rebates that are kicking into the inflation measurements, driving down the price increases of certain items, particularly electricity. So, you know, this quarter release that's coming out, it came in low last year. It's likely to come in low this year as well because of all the fiscal trajectory and fiscal manipulation of inflation data, the, you know, trickery to the numbers. So that is going to come through. So when you play that out, it probably shuts the door for rate rises, which just opened up a little bit over the last month or two. So we've said this, a number of times that, hey, interest rate rises are probably unlikely now. But then the last couple of months have opened up a door, slightly ajar. Markets had a 1 in 4 chance of rate rise. I think that will close down to 1 in 10 or 1 in 20 overnight. Speaking of which, what happened to markets? Did you take a quick look at this?
Only a very quick look, but it looks like they jumped and the dollar fell. So they were all very, very happy, I think, with the print and essentially ruling out rate rises and the cost of debt increasing. Yeah. So that seemed to be the immediate market reaction. We'll see if it tempers for the rest of the day. But
probably. So I think the general feeling was nervousness. That's how I felt. Nervous. I felt nervous for people. I felt nervous for Australians. I felt nervous for what this could mean over the next few months. I felt nervous for Sydney property. I don't know why I talk about it in that way, but I just felt nervous for the next little period ahead because some of the other things circling around are not that favorable. Economic growth is really slow. Although the employment market prints are really good, forward-looking indicators suggest weakness is on the horizon and we're about to, drive straight into that weak period. You can start seeing it in the data. There's a lot of things to be nervous about. Asking rents have started coming down as well.
Yeah, you've done a piece on housing. And I think there's a bit of and this is always the way with economic data releases and the way, inflation's managed, but there's always a bit of a time lag between what you're getting in the data release and potentially what you're feeling and seeing, on the ground as current conditions as of 31st of July. It's feeling and looking pretty weak, but you can get a data print that involves, 3 months ago, old data effectively, old as of today.
Yep.
And if that comes in high, then the RBA has to make decisions based on that. So I think, that's where a lot of the nervousness from a lot of people comes from is I think we don't really have that much of an inflation. Doesn't feel like we have that much of an inflation problem as of today.
Yep.
But maybe the data says we still do have a bit of an inflation problem over the last 3 to 6 months. And if that's all the RBA can go off, because they can't go off my or your finger in the wind, or anyone's finger in the wind, really, they try to, but they're using the data. So you could have some slightly old data that forces a decision that might not be really fit for current conditions. Yes. And that's where that nervousness comes in. It's if they do go up 25 bips, it could have some real negative consequences based on where we sit today. But luckily, it looks like that's avoided.
Yeah, exactly. I don't think they want to increase interest rates. I can tell by the way they're communicating. They don't want to do it. They're just do I have to do it?
Yeah.
And the reason why they would is big print today, the tax cuts going in, they'll be what do I do? You're kind of putting my hands behind my shoulders and saying, I've got to do what I got to do because of all the data that's here in front of me. But with this here, they can just let it go for a bit longer, which is exactly what they want to do. They've got a hiking reluctance at the moment. They've already done that. They've already taken it so far. They've done their insurance rate rises, as Michelle Bullock refers it to, late last year, where they had that another increase in interest rates. They put that insurance policy in place. They've already done that. They don't want to go any further. The world is changing. The world is now on their cutting cycle. The US this week, is it? Very, very soon will most likely begin their rate cutting cycle. That's the next big piece of information for this week. And once that does happen, then the world has well and truly begun its cutting cycle, and the RBA will be behind the world here because they were hiking later, but they don't want to be raising interest rates at the moment. It's not what they want to do. So let's go through this print in a little bit more detail. Obviously, we haven't had much time to look into it, so I'm going to be using my pre-research rather than the actual data release here. But do you mind just giving me a little bit of the 30-second take as to what is making up this print? What do we know so far?
Yeah, so the ones that have been identified so far, I've got here 4 components of the CPI basket that kind of drove the inflation number the highest. So housing, which is up 1.1%, food and non-alcoholic beverages, 1.2%, clothing and footwear, which was one that surprised me, but maybe I don't shop for clothes enough to be on top of that, 3.1%, and then alcohol and tobacco, 1.5%.
Yep.
That's what the ABS had identified in their kind of press release as the 4 biggest drivers, although I haven't actually been through the raw data that underpins it.
Yep. Let's go through housing because this is the video. So anyone watching this, I've just done a video about how the housing market specifically will be driving interest rates down. The reason for that is all of the lead indicators for the housing market, which feed into inflation, which is rents and the cost of construction. Those indicators are suggesting a lot of weakness today. It was suggesting a lot of strength last year, but right now asking rents are effectively flat and coming down quite aggressively in Sydney, and construction costs have just posted their smallest rise in 20 years. So these two factors drive the housing component of CPI. The housing component of CPI is 22% of the entire CPI basket. So when it goes up 1.1%, as Curtis just mentioned, it is a lot because it makes up such a large chunk of the CPI. Meanwhile, when clothing goes up, I think that makes up 5-6% of the CPI basket. It makes up, a fraction of housing. So even if it goes up by more, it's contributing less to the CPI itself. Housing is the largest weighting towards that CPI index, and it's come in pretty high, 1.1% again, which suggests that 4.5% yearly sort of rise. That 4.5%, that's going to trickle towards zero over the next couple quarters, and if it continues, it might even go negative for a little bit. I don't think that'll happen, but it could, particularly around migration and rents. And if that happens, you're taking away, you do the math on that. If housing is, making up 4.5% and it makes up a quarter of the inflation basket, do the quick math on that, it's almost a percentage point on its own of inflation. You take away a percentage point off a 3.8% inflation
we're in band.
We're in band.
Yeah.
That makes sense. So you're taking one of the biggest driver of inflation, so the biggest component of inflation is operating in reverse gear at the moment, but it is not in this CPI data yet. It will be, perhaps in the next one or the one after that.
Yeah.
Which is why the narrative is going to shift. I'm early in saying this. The narrative's going to shift. We've been talking about potential rate rise this year. Give it a couple of weeks. We're going to be changing the conversation completely and being like, November. Is a rate rise coming in November?
Rate cut, you mean?
Is a rate cut happening in November? That changes everything. We're changing the whole potential direction. We are way too early to be saying that, but the dominoes of what has to happen next is starting to move in that direction, particularly when you pay really close attention to what the future CPI data will look like by looking at the lead indicators today.
Yeah, I think there's another factor as well that for this category and for food and non-alcoholic beverages, where the RBA aren't going to want to raise rates in order to tamper down those two measures, if that makes sense. Obviously they're targeting trim mean, they're targeting the whole basket. But if the RBA, raises rates by 50 bips, 100 bips, they do something crazy, their ability to reduce housing inflation and to reduce the cost of food and people's demand for housing, demand for food is a lot more limited than the more discretionary elements of the basket. So I think if you're sitting there at the RBA and you've got your two highest contributors, housing and food, you're like, okay, how powerful are my rate rises, or how effective is changing the cash rate going to be in combating that? And that's I think another factor that if those two are, with those two leading the CPI basket, it probably puts a little bit less of a raising bias on the RBA. Whereas I'd say the other two measures like clothing, footwear, alcohol, tobacco, they to me sound a lot more discretionary. So for those ones, you're probably sitting there and going, okay, if I raise the cash rate, I should see demand for those, consumer demand for those two things should drop and CPI should drop. So I have a good one-to-one, I have a good transmission mechanism to hit that. But I don't think I think they know they don't have a very good transmission mechanism.
Alcohol?
Yeah, alcohol and tobacco.
No one's cutting their spending on alcohol or tobacco. It doesn't matter what interest rates are.
Inelastic?
That's as inelastic as it gets. I'm drinking, I am smoking. That's how people
Maybe it's
feel.
a negative...
It might have a negative impact.
loop. It's rates went up, alcohol consumption goes up.
Yeah.
But yeah, I think the RBA, if they're looking at those, they're going to be like, okay, housing and food, they're necessary spending items. They're, so what are our rate rises going to achieve there? So the fact that they make up such a significant portion of the higher end of the CPI basket, I think puts a little bit less pressure on them to raise rates as well.
Yep, that's true. So I got a few stats there. Clothing makes up 3% of the basket. So yeah, it could rise a lot. It doesn't really matter. It's such a small, little, tiny fraction. Health makes up 6%. So health would have been one of the big drivers of this inflation print as well, because it's double the size of clothing. And housing is 22%.
Yeah. But like, for example, if you had housing...
Food, 17.
If you had housing and food at like near zero, right? Like, let's say they weren't contributing to inflation, and then you had a whole bunch of more discretionary items in the basket that were contributing to inflation. Even if you got the same 0.8 trimmed mean result, like, I think that would give you, if you're the RBA, a lot more reason to potentially raise rates or be more concerned than if it's the non-discretionary items that are producing the highest part of the basket.
Yeah, exactly. Let's go through the one concerning item. So let's play devil's advocate. I'm going to increase interest rates because of this one thing that is in the inflation number. I'm trying to unpack it a little bit. So this is about non-tradable goods. So let's read this out. Non-tradable includes goods and services that are mostly influenced by domestic factors. Annual non-tradables inflation was 5%, unchanged from the March quarter. Price rises for new dwellings, rents, tobacco, and insurance contributed to the annual rise.
Yeah, so...
Meanwhile, just let me finish this bit off. Meanwhile, tradables inflation is at 0.9%, while non-tradables is at 5%. So big difference between the two.
Yeah, I think this is the RBA's way of trying to separate what they think is domestically driven versus like internationally driven. Because obviously they're more concerned about domestic-led inflation than, say, imported inflation in terms of what they do for rates. So yes, concerning that it seems to be domestically led, like our numbers, which I think we've probably known for a while now. Like, inflation has been happening for long enough that it's not the days of like the supply shock, transmitting through the economy in 6 months or something were 2 years ago. But yeah, that probably is, if you want to play devil's advocate, the thing they could point to if you did want to raise rates or you were looking for a reasoning to raise rates.
Yeah, I'd go so far. Let's just say the cash rate was 3.5%. That would probably be like, I'm on a very, very high keen bias. I'm really about to go, yes, let's increase interest rates. They might use this to increase interest rates. But they're not in that position. They're in the position where it's just like, I really don't want to go in that room and press that button where I increase interest rates. So this alone won't be enough. And also, when you break it down, 5%, it's driven by new dwellings, rents, insurance, and tobacco, which we kind of just went through and be like, does interest rates actually do much to any of these? Yes, it does, especially to new dwelling prices. I do think interest rates mean that there's far less people constructing. So yeah, the price of labor in the construction industry should go down. The price of materials should go down. So yes, it should impact that component of housing, which is a big driver. But surely the RBA know the lead indicator for construction costs. Be like, oh, look at that. It's come down. And these guys measure it in live pricing because they get spot prices for, frames and wood and steel and plumbing rates and stuff like that, while we get the fed through CPI data, which takes a bit more time to feed through here. And the live data tells us it's coming in really soft. So they'll know that, the business, the RBA is not just working. If I can find it out on Google in 10 minutes and, just look up CoreLogic's Cordell Cost of Construction Index, I'm sure the RBA, they might not put much weight on it, but they will be aware that, hey, look, this is going to track downwards in their own inflation forecasting when they're breaking up where they think inflation will be over quarters and quarters going ahead.
Yeah, so you wanted to play devil's advocate? You can go for it. Do you want to...
Yeah, I did it. That's it.
That's it?
That's it. That's as hard as I'm going to go. Okay. Don't increase interest rates, please. I say that because it is a different scenario we're in at the moment. People are genuinely feeling the pinch a little bit. Savings levels are lower. The employment market is weakening. It's real. Like, we're traversing through the storm, which is the expression that I've used.
There is an economic slowdown now. There's no economic growth. There's per capita, basically GDP recession.
Yeah, for 2 years.
Yeah.
It's ugly.
Yeah. So economic conditions are very, very weak on the ground. And like you say, the employment market is softening quite significantly. Might not hit the indicators yet.
Yes.
But yeah, everything's pointing to economic conditions being very, very soft.
Exactly. 100%. So that is the scenario we're in at the moment. The RBA has got no reason to increase interest rates. Inflation is at, 3.8%? It is too high, but, we're not miles away anymore, right? We might be one quarter-on-quarter print. Unlikely. Probably two quarter-on-quarter prints before it comes down. All the indicators I should show you this, Kurt. There's this like awesome chart by the RBA and their view of quarter-on-quarter data and where we are. So we've just hit this quarter, bang on, like this data release has come on. Then it shows next quarter, and the RBA have like a flat line. The inflation print, or whatever we've got, 3.8%, it's going to be 3.8% again, right? So whatever comes in next quarter is going to replace last quarter, but it's going to be the same number. That's kind of what they've got. Yeah. CBA and the major bank economists.
I saw this, yes.
I've got to ratchet down. Oh, you watched my YouTube video. Thanks, man. So it drops down a lot. So I don't know what they're doing in there, but like they must have some reason for it. I trust those economists as pretty smart people. They would have done that. And it's probably just more up-to-date live. And the chart from the RBA is they just haven't updated their forecast. So that may suggest something as well, that, hey, look, inflation is coming down, the headline number's lower. All those expectation theories are going to come down associated with inflation. The number is low, so people will adjust their behavior accordingly. And, maybe we can start providing some relief ahead of time. And we've got a little bit of cover because, maybe perhaps the US Fed had done a couple and Canada's done 3 or 4 and Europe's done 1 or 2. And we might be in a position where we have the same rate as them, by the end of the year. So that is the narrative pathway, the step-by-step to getting to a point where it's just like, hey, the RBA could, breathe a little bit, being like, yes, we need to provide some relief to this economy because the economy needs it at some point. And it might take a bit of time to provide relief as well.
Yeah, it will take a bit of time. I think they will have a reluctance to cut bias as well when we get there. So, and I think, basically the 3 big indicators like inflation, unemployment, and GDP, like I think they're all in a position now where my guess is they're going to move quite slowly. Like in terms of delta, like I don't think we're going to see big jumps in them in any particular direction. Like quarter on quarter, I just feel like they're going to move relatively slowly. Yes. So from my perspective, which could be wrong, maybe something will jump around, unemployment might jump up, GDP might plummet. It's possible, but I feel like we might be in a bit of a holding pattern for the next 2 quarters.
The one that I'll add to that, and I've been saying this for a little while now, but it's scary, the data, the lead indicating data. So two metrics to look at, job applications per job. That is like off the charts. Like it's just skyrocketed up, being like, whoa, what's happened here? Like it looks really weird. And then the number of vacancies that are available, that is also, when you correlate that to the unemployment rate, they're both spiking. Like it's a very sharp V that is happening over the last 6 months or so. So the lagged impact of interest rates, I think it might just, we're learning this because it's been a decade since the last rate rising cycle. We're learning some of it has an 18-month impact, particularly the construction sector, which is probably getting battered at the moment, where new approval rates was like 100. We had the lowest new approval dwelling rate this financial year in over 10 years, while everyone's got the goal of we're going to build more homes, being like, we're miles off it. So basically the construction industry has gone from we are building a peak level to I've halved it. The number of jobs that are going to be lost across the country in that sector is enormous, but it happens later. It happens now. It happens a year, 2 years, 3 years after rate rises, and then it picks up again a year or 2 afterwards because it takes a while to finish jobs, to finish projects, have it all tied up, have the pipeline dry up, and there's nothing coming into the pipeline or a very, very low amount. And the benchmark of the number of people in the industry is really, really high because it's just volatile at the moment. So that's another industry where you see unemployment danger signs, I guess. These are the rate-sensitive sectors. It's just they're coming to the employment market now, and it's in the data here. So it wouldn't surprise me if there is odd variations in this employment prints. It comes out every month, so it's a bit hard to see. But over the next 5 prints, it wouldn't surprise me being like, what's happened here? Like, all this lead indicator has just fled through into here. And I sense the RBA is probably a bit cautious about that. They seem cautious when they're talking about it. They're like, oh, we're a bit worried by this. They're like, unemployment's at 4. So, they sound worried because I think they've got an eye on the future.
Yeah, I think so. I think it'll just be interesting to see how it flows through the data. Like, I think these things, when unemployment's being released monthly, like it kind of just trickles through. So my instinct would be that it'll be small changes over the next 6 months. But one of the downsides of unemployment is even if you start cutting rates, it doesn't reverse unemployment. Like it's the same thing, right?
No, right.
You still have unemployment rising as rates get cut. because the impacts, there's lags from 18 months ago, 2 years ago, a year ago. So it's the decisions that businesses and firms were making a year ago about people's employment that are hitting the data now. So that's where, if unemployment is going up quickly, that's a concern because it's not something that you can easily reverse. But yeah, my instinct is I reckon it'll be 6 months of Michelle Bullock and the RBA
just doing nothing.
Yeah, feet up on the
100%.
desk.
Yeah. That is baseline scenario now. Feet up on the desk. That sums it up. This inflation data piece is so good for Australians. The RBA is going to have their feet up on the desk and being like, we don't know what she can see
out her window in Martin Place, but just like, yep. Book in some longer lunch breaks. I don't know. Just be like, all right, I think
everyone relax.
I don't need to do 12-hour days anymore. I'm not stressed. Like, we're good.
Yeah. You can write. I can even write her, speech afterwards. We're not ruling anything in or out. You will hear that line from her next week when the RBA release their decision. But yeah, that's just her repeating what has been said time and time again.
Yeah, I think that's fair because, if the data, I would say there's unlikely anything happens until the next quarterly print. But if you got a 1.5% print, they're going to raise rates, and if you got a 0.5% print, they might cut them. So, technically, what she's saying is right, but I think the pressure to need to actually action something has disappeared.
Exactly. Anyway, we'll leave it there. If you have any questions and you want a little bit more insight, do me a big favor and jump on our YouTube channel and hit that subscribe button there and follow our research, our intel there. Many of you have also reached out to us about this job ad that is out. Don't mean to disappoint, but we have just filled it. So thank you all for reaching out to us and the number of applications that have come through. I really, really appreciate all your support and wanting to work with us. It's been a pleasure getting to know many of you through that process. And yeah, if you can, jump on our YouTube channel. You'll learn a lot about the economy, housing inflation, interest rates, things like that, where I go through a deep dive of all the data, charts, and storyboard it all out and where the Australian economy is at. We talk through a whole range of lending things there too. Till the next one.